Hello everybody and welcome to the first session of the NZX Virtual Global Dairy Seminar for 2020, brought to you by our gold sponsors StoneX, Global Dairy Trade and Interfood. Today's session is brought to you by our gold sponsor GDT, and we've got Eric Hansen, the Director at Global Dairy Trade, who's going to be providing an educational session on GDT Events, where he's going to cover how the auction mechanism works, including things like rollbacks and the cream group. So before we start, if you guys haven't already, make sure that you download the NZX Event app to take advantage of our networking features, where you can access and communicate with all of the other attendees, as well as access to Q&A and to live polls. And recordings of this event as well will be posted there, as well as speaker and sponsor details. So lots and lots of information there. A link to the web version of the app will be found in the chat box of GoToWebinar, which will be down on the bottom right screen. You'll see a little flashing bubble. If you click on that, it will bring up the link and a little red flashing bubble, and that will take you to the website where you can either download the app or use the web-based version. So if you've got any questions, please submit these through the app. We'll be running Q&A following Eric's presentation. At the moment, all attendees have been muted, but this shouldn't impact you hearing us. If you're having trouble, please have a look at the troubleshooting options on the left-hand side of your screen. We'll be sending out recordings at the end of the webinar, so if you miss anything, you can pick up the recording and watch at your leisure. Right, I'm going to stop talking now. The one you really want to listen to is Eric, so I'm going to hand over to him now to kick off today's session. We'll just transfer the presentation mode and then he will get into it.
Okay, thank you, Nick, for the introduction, and look, welcome everybody to this presentation. Thank you for coming along, and I hope you find it informative. So what we'll cover today, as Nick talked about, excuse me, we will cover an overview of GDT events. I know there's a wide range of people online, so some of you may not be that familiar with GDT. We'll spend a few minutes on that, and then we'll get into the meat of the presentation around how the GDT auction mechanism works. We'll move into rollbacks and the cream group. First up, I'd like to really thank everybody who responded to the survey a few weeks ago on what is of interest to you. We certainly tried to incorporate those in the presentation today, and certainly the rollbacks and the cream group were two very popular topics. So let's move on then to a little bit of an overview of GDT events. GDT was launched in 2008 with our GDT events platform, and it remains our flagship platform. It does around about US $2 to $2.5 billion worth of sales per annum, and we believe it brings a number of strengths to the price discovery process. First of all, it is seen as a best practice method for price discovery. Really delighted today to see that Professor Paul Milgram was one of two people awarded Nobel Prize in economics for auction theory, and Paul Milgram was in fact on the advisory group when we were developing GDT. He was an advisor to CRA Limited, who developed and run the auctions. So great to see Paul Milgram getting recognised for that work, and I think great backing for this type of auction as well, which was come out of the recommendations from Paul Milgram and other advisors. GDT events, of course, we have an oversight board which ensures integrity and brings the customer voice. The oversight board has 3 buyers, 3 sellers and 3 financial market representatives, including, we're pleased to have NZX, Nick Morris, head of derivatives sitting on the oversight board with us, providing the insights from a financial markets exchange point of view. We have a global brand, of course. GDT Events platform is by far the largest dairy trading platform in the world of dairy, and of course our prices go around the world, and it's recognized globally. Core to GDT, of course, is our sellers and our bidders, and I'll talk about shortly. We have a number of sellers, but a key characteristic there is they offer fairly large quantities of generic products consistently over time. And that's because we want to have price discovery, and we want to see how prices are moving over time. So we always want sellers who are selling fairly significant quantities, the same generic products consistently repeated over time, so that you get a good price series to see how the market for dairy is moving. On the other side, of course, bidders are critical, and you'll see in following slides that we have a very large and diverse pool of bidders, and so we'll talk a little bit about that. And then, of course, we have the financial market. We have the NZX dairy derivatives market that uses the winning prices from GDT for particular products as settlement prices for their futures and options contracts. So we're really very pleased to have the NZX involved with us in that way. Moving on then to sellers. We have a range of sellers. We have sellers from all three of the major exporting regions. So that's New Zealand, Europe, and the US. From New Zealand, of course, we have Fonterra, Oceania region with a wide range of products. You can see there all the way from the cream products, AMF and butter, through to the various powders. From Europe, we've had for a long time now Arla Foods Limited offering buttermilk powder, or BMP, and skim milk powder. And then also Arla Food Ingredients from Europe. So we treat Arla Foods and AFI, or Arla Food Ingredients, as two separate sellers. They do have their separate boards, and they are signed up as separate sellers in terms of participation agreements and so forth. So AFI specialises in lactose and whey products, and for some time now AFI have been selling lactose on GDT Events. And then, of course, from North America, we have Dairy America, who in fact were our very first external seller on the platform other than Fonterra, and then they recently rejoined our platform in July last year and are selling skim milk powder on a consistent basis. Two other sellers you'll note there, Amul from India and Polish Dairy from Poland, both consistently offering products, but not at a pricing level that is meeting the market's needs. So they're active in terms of offering products, but not selling a significant quantity, unlike the other sellers. Moving on to the bidders side, over the last financial year to 31 July, GDT Trading Events attracted 319 participating bidders from over 80 countries, purchasing a total of 713,000 metric tonnes. So you can see from the chart on the screen a wide range, a diversified large pool of bidders. The largest group being North Asia in the dark green. Let's see if that works, with 97 bidders. So around about 1/3 of the total number of bidders, accounting for roughly 50% of the total purchases, which then means that actually 50% of the sales are to parties outside of North Asia. So a large and diversified pool of sellers. A couple of questions that have come through from people already. Might as well tackle those now. One is, who are the participants? Who are the bidders? Are they small or are they large? The truth is, there's a huge range of bidders, from very small parties that buy, maybe 1 or 2 container loads 2 or 3 times a year, through to very large buyers who buy tens of thousands of tonnes across a year. That means, very small, all the way up to multinationals, through to the much smaller operators, and quite a range of both end-use customers who are going to use the product in further manufacturing, and parties who resell product in their local market. And it does tend to be, we have a pretty stable base of bidders, 319. It's the same people over and over on a repeated basis buying product, rather than a different set of people each time. A final question here is what happens after someone's bought a product. So GDT is all about matching buyer to seller and discovering the price. So for us, we still like to leave ultimately the seller in charge of the customer relationship. So after the auction is completed, the buyer and seller, get informed of how much they've bought or traded, what is the price, and then the seller goes on to execute those contracts, do the logistics, the credit terms in the normal way that they do with all their other business. So I hope that's answered a few questions that people had. Finally, in terms of overview, when we look at the number of bidders across products, we have the top 4 products: skim milk powder, whole milk powder, AMF and butter, all attracting over 100 bidders annually. And in the case of skim milk powder and whole milk powder, getting close to that 200 mark. So what this means is that if you're looking at the prices coming out of GDT, I think you can take a lot of assurance that there is a good number of bidders participating, and the prices coming out of GDT reflect what the buyers are prepared to pay on the day. Right, let's get into the meat of it and look at an overview of how the auction works. We'll look at then rollbacks, which is also part of how it works really, and the cream group. And when I go through the cream group, there will be an opportunity also for me to also delve further into how the auction works. And so hopefully by the end of that process, you'll have a very thorough understanding of some of the sophistication in this auction and the way it works to maximize liquidity and bring about the best outcomes overall. Okay, high level overview of how the auction mechanism works. We're going to look at this chart where quantities bid are going to be on the vertical axis, and then round by round the prices are going to be on the horizontal axis. So this type of auction is known as a clock auction, and that means that it goes through multiple rounds of bidding to arrive at an endpoint where the product is sold and the price is known. So about 1 week before the auction starts, each seller puts forward the quantity they would like to sell. Here we have the offer quantity, so it might be 1,000 tonnes, and I'll go into a bit more detail on that. So it might be, say, 1,000 tonnes of whole milk powder, contract period 2, and the seller also sets their starting price. So these are set by the seller, not by GDT, and every seller has to set their supply quantities, their starting prices, independently of all other sellers. No one gets to see what other people are doing, so it has to be an independent competitive process. So sellers set these things about a week ahead of time. The data goes through to CRA International in Boston, who run the auction for us. They will run a little dummy auction to make sure all the data is going to work correctly in the auction process. There'll be a double check back that all the data is correct. And then at the appointed time when the auction opens, bidders will have seen the starting price and the offer quantities over the prior few days. And when the auction opens, the starting price for the product in this case, for example, is $2,000 per metric tonne, and the bidder just simply puts in how much am I prepared to buy, how many metric tonnes would I be prepared to buy at that $2,000. The idea is that the starting price should be highly attractive to bidders. It should be clearly well below the current market price, whatever that is, and so it attracts a lot of bids. And so typically we find that the first round bids will be 2, 3, or for some of the smaller products, even up to 5 times the amount of product available. So there's excess demand. And so then the trading manager, that's CRA, set the price for the next round. In this case, they've increased the price by $300 from $2,000 to $3,200. And the new bidding round opens. So nothing has been sold. There was excess demand in the previous round, so it's not a clearing price. And so no bidder has secured product. There is now a higher price, and bidders re-enter the bids that they would be prepared to pay at this new announced price. Oops, gone the wrong way. As you would expect, as the price goes up, you would expect that bidders will reduce the volumes that they wish to buy. And so that just goes on in a round by round process with the prices increasing and demand falling as price increases. And typically, you know, the price increments get smaller and smaller. So the first increase was $300, next round was $200, $100 increase, $75, $25, etc. So what the trading manager is trying to do is he's trying to land, he or she is trying to land the demand within the offer quantity. And so you'll get a final increase in price when the demand equals supply. That then becomes the winning price, and this is the price that all bidders pay. So a feature of GDT is whatever is the winning price, every single bidder pays that price, and that's only determined by the end of the auction, and nobody buys anything prior to the winning price being determined. One of the features of this option is we have what's known as a sinking eligibility rule. So it means that when, you know, if I bid in the first round, if I bid say 500 tonnes in the first round across a range of products, then that 500 tonnes is the maximum I can bid in the next round. So as the price is going up, as a bidder, I shouldn't want to buy more. I'm either going to want to buy the same amount or a smaller quantity. So I bid say 500 tonnes in the first round, price goes up, maybe I drop my bids across products to 400 tonnes. Now my new lid, sinking lid, is 400 tonnes, and as I keep dropping my total bids across products, that sinking lid keeps sinking. I'm still able to shift bids across products and across contract periods, but the total is managed in that way. And what that does is it ensures that bidders have to bid the full amount that they want to buy at that price. You can't hold back and say, look, I'm not going to bid anything today until it gets to round 5 and then all of a sudden strike. It's called the snake in the grass strategy, strike late and put some new bids in. If you bid 0 at the start, then your sinking lid is dropping to 0 and you're out of the auction. So it forces people to come into the auction if they're interested to buy, to reveal how much they want to buy, and that creates an orderly auction process. So that's the basics of how the auction mechanism works. I mentioned Paul Milgram earlier around the design, and one of the things we would say is that this is really a best practice auction format, and there's 2 sort of angles to that. One is the uniform price that everybody pays at the end. Everybody pays the price that's achieved. And what that means is that as a bidder, it's very simple. You just have to look at the price and decide whether you're prepared to pay that price and how much you'd be willing to buy. You don't have to get into all sorts of strategic research, trying to understand what everybody else is prepared to pay. With a uniform price option, because you're going to pay what everybody else is going to pay, you just bid up until what you think it is worth. So it's a very simple process for a bidder. And it also means with a uniform price, everybody's getting the same price, and that's seen as inherently fair method. As a clock auction, and by a clock auction we mean this sort of round by round process that I talked through, that's seen as best practice as well when there's a lot of uncertainty about what the price is, and when there's what's known as common value, so everybody inherently values the product in a common way. And the whole idea of the round by round process is that it is revealing information to bidders round by round, so they get to see, what was the bid ratio last round, how much is the price increasing, and this gives people confidence as to what's happening in the market and helps them to bid confidently during a trading event. So the round by round process, although it's a little bit takes time, it is something that helps to give bidders who are not sure about where the market's at time. It reveals information to them as they go through the process. And then alongside that, we have an auto bid function. So for those that don't want to spend the time in the real, going through the clock auction process, they can just put in their auto bids, how much they're prepared to buy at what price limits, and the system will manage that for them. And so it's quite possible to bid and buy product without actually turning up to the live auction itself. So that's a picture of how it works in high level. Let's turn then to rollbacks, and I'll try to take you through this relatively simply. At its heart, it is a fairly simple process. So the first thing to note about rollbacks is that we have them because of this clock auction process. So let's start with, say, a seller that wants to sell, say, a maximum of 1,000 tonnes. They don't want to sell more than that, but they also have a minimum. They don't want to be selling less than 900 tonnes because that will just mean they've got stock left over. So as we go through the auction process, there's excess demand initially. Round 1, round 2, there's still excess demand. Price has gone up. Trading manager puts the price up for the next round, and whoops, demand fell off a cliff, or it fell quite significantly. Now, if we were to stop there, that would be pretty unfortunate, because it would mean that the seller has sold only a fairly small quantity. In fact, a lot less than what they wanted to sell. They wanted to sell up to 1,000 tonnes and not less than 900, and would have sold all the way down here. And also, it's not a great experience for buyers, because they've spent time going through this auction, and at the end of the day, you've only secured relatively small amounts. So the system then does a rollback, and that's a pretty simple two-stage process. The first stage is to take the bids that were submitted in the most recent round at the price of $29.35, put them in the first part of the bid stack, and then go back to the previous round and look at the bids that were bid at the lower price of $29.15, and take a portion of those bids until the demand or the bid stack gets up to the maximum supply. So the seller will have sold the full amount if it ends at that point. So there's a kind of a random draw to take these bids. It's done in a fair way, an objective way. There's a random draw, so everybody has an equal chance for each of their metric tons to go into the rollback. And so there's a two-step process. This is what's called a two-price bid stack. There's the higher price, and then there's the bids at the lower price. And if the auction ends at this point, then everybody will win product at the $29.15. Okay, even though some bidders were prepared to pay more, it's a uniform price auction, so everybody pays the same amount. So that's the basics of a rollback. I think we'll just recap that a little bit again so that you've got it fixed in your mind. We've gone through a process where demand's gone down round by round, the price has been going up, then all of a sudden the bids have dropped below the minimum supply, and so the first step again is just to take those. Second step is to then go back another round, take the extra bids at the lower price, put them in to create a two-price bid stack. so that the seller can be assured of selling at least their minimum and quite often up to their maximum supply. So if it stops there, that's fine, but what happens in future bidding rounds? Well, the next round opens with a price or at the higher announced price, the same price that was in operation in the previous round, 29.35, and bids come in that round. Now, it can be that more bids will come in at that higher price and knock out some of the lower price bids, because it could be that someone is bidding on another contract period or another product, and those prices are going up more, and so now they want to buy the cheaper product, and so they switch their bids in. And so even though they, back in round 3, they weren't prepared to buy at that price, now they are. So more bids have come in at the higher price. We can't sell more than the maximum, and so some of the smaller or the lower price bids get knocked out. Now, again, if it stops there, then that's fine. The winning price will be 29.15, but there may be enough bids coming in to knock out all the rollbacks, and if that occurs, then the rollback ceases, and we're back into the world where there's some excess supply, excess demand, and the price will keep increasing through subsequent rounds until the demand drops to within the green band. So that's the essence of rollbacks. Turning then to the cream group. The basic purpose of the cream group is really about enhancing liquidity, and we try to do this in many ways. We're always interested in more supply from our suppliers, our existing suppliers, and to attract more sellers from Europe and the US to join the platform and offer more product that will improve liquidity. We've looked at pooling products across sellers in the past, where, for example, we have sellers from multiple sellers from the US. We looked at pooling their products because they're very much the same, and so that's another way of creating liquidity. But a third way is to what we call pooling across products, and as I'll talk about over the next few slides, that is something that GDT has always done right from the start, and we've extended it recently to the cream group. So let's work through that in a very visual way. You can have three, if we think of whole milk powder with regular instant UHT, they could be sold as separate product pools, right? You could, seller might be interested to sell 3,000 tons. They could put 1,000 on regular, 1,000 on UHT, 1,000 on instant. That would be fine, but they would be operating separately, and you end up with, possibly a few large bidders who are quite significant relative to the total size of the pool, and they could dominate. You get demand shocks, supply shocks. It's going to have a big impact on price. So whenever you're in a situation where the seller has flexibility across the products, then you can pull the products together. So for whole milk powder, for example, the seller, say Fonterra, they can make instant regular UHT in the same plants. So if they're interested in selling 3,000 tons of whole milk powder, they can pull them all together and create one bigger pool. And as you can see, the effect of that visually, of course, is that every bidder is now a smaller part of a much larger pool. And so it's more, individual bidders have less impact, more liquidity for them. And if you get shocks, demand shocks across individual products, then it tends to average out. So it does, it's a way of enhancing liquidity and smoothing out the pricing process. We'll delve into this a little bit more detail. So the cream group then is an extension of our established pooling process. So, we've always had what we call sales groups. I've talked about whole milk powder. We've got, say, AMF as a sales group here that has 3 products: the regular product, the premium 210 kg, and the premium 1000 kg. So that's a sales group that aggregates across individual products. And similarly for butter, we have the salted and the unsalted versions. So these sort of sales groups, as we call them, have been part of GDT right from the start. And then in 2016, we thought, well, we can take that one step further and create what's called the cream group. And that's made easy because if you think of AMF and hydrous milk fat, that's 100% milk fat. And whereas butter is 83% milk fat and 17% moisture or water. And so effectively they, underlying them, they're both milk fat products. So the seller's really selling cream or milk fat, just made up in different products. So there's, we can look through how does those supply parameters get determined? How is pricing determined? So let's work through a few slides on that. So to understand the cream group, I think I always find it easiest to talk through what happens with a sales group and then to show why, how the cream group compares to that. So let's start with an example. We have whole milk powder contract 2 as a sales group, say with the 3 products, and the seller has enough milk supply and plant capacity to sell, say, 1,000 metric tons of whole milk powder, and they want to sell at least 900 metric tons, but not more than 1,000 metric tons like we were looking on those slides earlier. Their plant is flexible, it can make regular, instant or UHT, so that means that they want to sell a total of 1,000 and they can sell a total of each of these products of up to 1,000, provided that in total across the 3 products it adds up to not less than 900. So here we have the whole milk powder sales group, minimum supply of 900, maximum supply of 1,000, and then the 3 individual, I get it to come up, oops, I got clicked off, 3 individual products. So we can see whole milk powder, regular contract 2, the supply range is between 0 because you don't have to sell any, but you can sell up to 1,000 metric tons of regular. So that's the min max range. Gotta remember to use the mouse. And then the other 2 products similarly, they have a supply range between 0 and 1,000 metric tons. So in total, we want to sell between 900 and 1,000 of whole milk powder, but any combination of these products to add up to the total. So one possible outcome is we sell 1,000 tons of regular and nothing of instant and UHT that satisfies the constraints. Or another sort of example is actually we sell some of regular, some of instant and some of UHT. It really depends on what the bidders want to do. But that will, as long as it adds up, the 3 products add up to being not more than 1,000 tons, then that's going to be a clearing outcome. So the cream group is similar to that, and I'll just walk you through how that works. It's got a few other wrinkles to do with it because of cream, because of the milk fat percentages. So suppose we start with 1,000 metric tons of milk fat. A seller, before we introduce the cream group, might want to say sell 500 of that as AMF and 500 as butter. Then you would see the minimum maximum supply ranges set maximum 500 of AMF because 500 metric tons of milk fat, it's 100% milk fat, so it'll make 500 tons of AMF. Whereas butter is 83% milk fat. So if you've got 500 tons of milk fat, then with that 500 tons of milk fat, you can actually make 600 tons of butter, right? Because the rest is moisture. So you'll see that the maximum supply for butter would actually be 600 metric tons. So now what happens with the cream group? The seller has 1,000 metric tons they want to sell of milk fat. They want to sell at least 900, not less than 1,000. And say the seller wants to sell at least 300 metric tons of each of the products. So 300 of AMF and 300 of butter, because they don't have full flexibility or they want to make sure they're providing at least a base level of product to their customers. So the result of that, though, is that if you must sell 300 metric tons of milk fat of AMF, then you need to put aside 300 tons of milk fat, right? Because it's 100 AMF is 100% butter. Whereas if you want to sell a minimum of 300 metric tons of butter, because it's 83% milk fat, you only need 250 metric tons of milk fat to do that. So you have to put aside the 300 tons for the AMF and the 250 metric tons for the butter. So a total of 550 put aside out of the 1,000. And so that leaves 450 metric tons, excuse me, of milk fat that you can shift between AMF and butter according to where demand is strongest. So it's possible then to sell up to 750 metric tons of AMF, because there was the 300 that we put aside, plus the additional 450 of milk fat that you could use all of that for AMF. Or you can sell up to 845 of butter, because there's the 300 you put aside as a reserve, the minimum, and then if you use all of the 450 metric tons of milk fat and multiply by the fact that it's only 83%, you get to 845. So now you can see that the effect of introducing the cream group is that the supply ranges for AMF and butter are much larger than they were previously. The dashed lines represent what we had before the cream group. So there's a lot more flexibility to meet the demands of buyers and sellers according to what they want to buy. So just to briefly recap on that, we've got a certain amount of milk fat that we want to sell. So that's this milk fat setting up here. We've got a certain amount of AMF and butter as minimums that the seller wants to ensure they sell at least those numbers. So we reserve milk fat for that. And then the remaining milk fat that hasn't been reserved is available to flex across the two products. And that creates the range of flexibility that you can see in these charts. So as a result, the auction will proceed and take in the bids for AMF and butter, and will arrive at a combination that adds up to selling 1,000 tonnes of milk fat through some combination of AMF and butter. And in this example, you can see, for example, the amount of AMF sold actually is below what would have been sold without the cream group. It's below the bottom dash line, and the butter, we've actually sold, in this case, more butter than it would have been possible to sell without the cream group. So, you've just got a lot more flexibility. Final area to look at is pricing. And again, I want to just do that by looking at how pricing works for a sales group, and then talk through for the cream group. So as I said earlier, the seller will set a starting price for each product. They will set differentials between the products if they like. So instant and UHT may be more expensive than regular. And if they do that, the auction system will try and maintain those differentials throughout the process. So as it goes through round by round bidding, you're going to get bids coming in at various levels on the different products. That's going to be measured at the sales group level. So there's excess supply for whole milk powder C2 sales group here. Even though there's not excess supply for instant and UHT, because the sales group as a whole is oversubscribed, there will be a price increase. So suppose there's sufficient excess demand to warrant a $200 price increase at the sales group, then the regular price will be put up by $200, as will the instant and UHT. They get the same price increment wherever that's feasible, unless there's some constraint preventing that happening. And then in the next round again, new bids come in. Again, the total bids across the products are added up at the sales group level. There's excess demand. Now the price is going to go up by 100. And again, the individual products will go up by 100. So that occurs even though those products, none of those individual products are actually oversubscribed. They're all within their subscribed region between 1,000 and 0. But for the sales group as a whole, it is oversubscribed. So prices have to keep going up because the seller doesn't want to sell more than 1,000 tonnes in total. And then we have a round where the sales group is subscribed. Then there's no need for any further price increases. So again, the individual products will have zero price change, and that will be, that will determine then the outcome. So the cream group is very much similar to that, with a few wrinkles. So again, the seller sets their starting prices, and they set a starting price actually for milk fat as well as for the individual products. And the system will try and equalize prices across AMF and butter on a milk fat basis. So it will take into account the incremental production cost. It costs different amounts to produce butter than it costs to produce AMF, and those parameters are in the system and manage to try and achieve an overall equal return on a milk fat basis. So how that works, we have first round of bidding, AMF bids come in, butter bids come in. The total demand for milk fat is there's excess demand, and so again, the price of milk fat is going to increase. So there's excess demand. System says, look, milk fat price in the background has got to go up by $200, and as a result of that, because AMF is 100% milk fat, its price will go up by $200, whereas butter is 83% milk fat. So a $200 increase in milk fat implies a $166 increase in butter. And then we go another round, just coming to the end of the presentation. $100 increase will flow through, and then again, once milk fat is in equilibrium, then there's zero increases in price, and that's reflected in the individual products. Now, this is a very simplified representation, and there's quite a lot of different constraints and factors that can mean that in practice, in any given bidding round, the price changes may not be exactly proportionate to how I've discussed, but that's conceptually how it works. Just like to leave you with this link here for those that would like to understand a bit more about the price discovery process, all the different factors that go into it. There's a document called Summary of Price Discovery Process on our website. So you go to the Global Dairy Trade Information website, homepage, look up at GDT Events and then reference material, and you should see it there. It's a couple of pages of Word document just talking through all the factors that come into it if that's of interest to you. So thank you for joining us today. Really appreciate it. I think we've covered a lot of different concepts there, and so that that what we've got on screen is we'd be very happy to take questions. Anybody who would like to send in questions at help@globaldairytrade.com, most welcome. We will respond to all questions either directly by email or by contacting you. So thank you again, and I hope that made some sense. Over to you, Nick.
Thanks very much, Eric. That was there's a lot of information in there. It was really really thorough and great. So thank you very much. Unfortunately, everybody, we're quite tight on time because we've got another session starting in about 13 minutes. So we've got a number of questions that have come through the Slido app. So we will send them through to Eric and the team, and they will get back directly to you. And if you've got questions that come up in future sessions and you want to ask directly back to the GDT session, then we can funnel those through to Eric and the team as well. So thank you very much for everyone joining today. Up next, we've got Jason Bray from StoneX, and he's going to be talking about index pricing for physical delivery, as well as exchange for physical trade types on the NZX. So that's coming up next, along with a pretty dense program over the next couple of days. So just a final thank you very much to Eric and the team at GDT. Really appreciate you giving your time and your insights. And we'll look forward to seeing you. Thank you, and we'll look forward to seeing everybody at the upcoming sessions, and hopefully see you at the next session, which starts in 12 minutes with Jason.
Thank you, everybody. Hope you have a good day.